Hello, my name is Elliott. I'm editor of Personal Finance as well as the Energy Strategist. Today I want to talk a little bit about what I see going forward for the general market and the economy overall. What we've really seen this year, 2010, is that at the very beginning of the year, things look to be accelerating a little bit. A lot of analysts out there on Wall Street raised their estimates for economic growth. And things generally kind of got a little ahead of themselves. What we've really seen, as I've been saying now for more than a year, is really a lumpy recovery in the U.S. That's why we've seen unemployment stubbornly high. We've seen a lot of volatility in payrolls numbers. And we've just seen certain industries and certain sectors of the economy doing quite well and others not so much. And that's going to continue generally going forward. However, in the shorter term, what we saw was that starting in about May, June, we saw what a lot of economists have come to refer to as a soft patch for the U.S. economy. A lot of the data deteriorated a little bit. On the manufacturing side, we saw a little bit of a slowdown in the PMI, the Purchasing Managers Index numbers. The leading economic indicators began to soften a little bit. Nothing really turned negative or really turned to the point where things looked outright recessionary. However, there was a notable softening. We could certainly see that in the jobs figures. Generally speaking, the jobs figures for June, July, and August were pretty soft and a little bit below expectations. What that did serve to do was bring down expectations for future growth. So we saw a lot of big Wall Street banks lowering their forecast for U.S. GDP growth for 2010 and for 2011. And really in the popular media, what you saw a lot of was talking about a double-dip recession. Now one of the key themes in personal finance over the past year and a half has been that we are seeing a cyclical recovery for the U.S. economy. And secondly, we will not see a double dip. And we still believe that to be the case. And I think that's really been borne out in the data that we've seen since September. We've seen in the most recent employment report, which was the October unemployment report released in early November, we saw the BLS, Bureau of Labor Statistics, actually revise higher the data for the last 3 months. So October, September, and August data was revised higher, indicating that jobs growth was a lot stronger than had previously been expected. And I'm really talking here about private non-farm payrolls. Forget what the government's doing and what's going on with census. But just looking at the private payrolls data, we've seen a notable uptick in job creation over the last 3 months. At 159,000 for October, we're still a little bit below where one might expect following such a deep recession as we saw from 2007 to 2009, but we're certainly heading in the right direction. And I think what we're seeing is a continuation of this sort of lumpy story. Now we're not seeing a soft patch, we're actually seeing a little bit of a mini acceleration in U.S. economic growth. That's been borne out subsequently by the initial jobless claims numbers, and we're seeing it in a lot of non-government data as well. Rail car loadings are up quite nicely. We're seeing an uptick in oil demand, and we're hearing about that from a number of different sectors. Obviously listening to a lot of third quarter earnings conference calls here over the last couple of weeks. Every quarter this is a very busy time for us. Reading through and listening to a lot of these calls, we've heard from a lot of companies, for example, that own refined products pipelines. One in particular that I follow quite closely indicated that diesel volumes of diesel fuel traveling across their pipelines were up by 25%. And that's excluding the effects of acquisitions. So we are seeing really a recovery in the U.S. side of the world economy. How about the emerging markets? Well, I think what we've really seen there is basically a soft landing. Chinese economic data also softened a little bit, or decelerated is really a better term, a little bit, around the same time as the U.S. data. That's now picking up again. The Chinese government obviously tightened monetary conditions and has sort of tapped on the brakes a little bit. But really what they've done is they brought Chinese economic growth down from really, really strong levels, 12% plus at the beginning of this year growth, down to more that 8-9% range. And I actually think that the data is a little bit stronger than most economists expect. And so I think you're going to see Chinese growth estimates sort of revised higher for 2011 as well. So we're seeing continued strong growth from emerging markets, China, India, and we're seeing what I believe to be a pretty obvious reacceleration of economic data in countries like the US and really in Western Europe. One interesting stat on Western Europe is that contrary to all expectations, Western European oil demand, a pretty good sign of growth in the economy, actually continued to remain positive year over year, straight through the third quarter, despite a fiscal crisis and all the concerns about European debt in the peripheral economies of Italy and Spain and Greece. Really a lot of the themes that we've been talking about in these videos and also talking about in the newsletter have come to fruition. We're not going to see a double dip recession in the U.S. It's nearly impossible now, in fact, because it's really 5 quarters of straight economic growth. And I don't think we're going to see any sort of a return to recession next year. In fact, I think that 2011 could actually be a very good year for the stock market. And I think we could see a real reacceleration, a real pickup in economic data in the first half of next year. And I think that's going to catalyze a pretty significant rally for U.S. stocks and the market, the global stock markets in general. Also, another point to keep in mind is really one on the political front. Obviously, the midterm elections in the United States delivered sort of as expected results. I would say generally the pickup for the Republicans in the U.S. House of Representatives is probably a little higher than most analysts had expected heading into the election. In the Senate, roughly in line. But generally what we're seeing is that Republicans are now in control of the House of Representatives by a nice margin. In the Senate, it's very tight. The Democrats have retained control, but it's such a small margin that it can really swing either way on certain pieces of legislation. What does this mean? Generally speaking, I see this increasing the odds of an extension of all of the Bush-era tax cuts. It's for all Americans for probably at least 1 year, most likely 2 years. I expect that to happen in the so-called lame duck session at the end of this year. If not, I expect it to happen early in 2011. I think there's plenty of votes from Democrats in the Senate that will come across the aisle and vote for that. And that's generally going to be a good thing. One thing that would be a risk for the economy is if those cuts are not extended and we see a tax increase early next year that could cut short some of the improvement in the economy that we've been seeing of late. Another interesting point to bring up would be what happens with the tax laws governing repatriation of foreign profits. I actually think the odds of something passed there are also rising. Generally speaking, this would be a major positive for the market. Companies like Cisco, for example, have a lot of earnings outside the United States that they don't want to bring home because of the high tax rates that they would have to pay. They've stated pretty directly that they would create jobs in the United States if they could repatriate that cash. I think it's going to be pretty hard to argue against that politically, especially after the recent election. So I think that's also going to be a positive for the market. After that, looking forward over the next 2 years, what you're really going to see is basically gridlock. You're going to see some bills obviously passed, some compromise measures passed, but you're not going to see any of the large sweeping bits of legislation that we've seen over the last two years. Nothing more like healthcare reform or financial regulatory reform. In fact, you might see some of the clauses of those reform bills actually roll back. I don't think you're going to see an outright repeal of any of those major bits of legislation, but certainly a rollback is possible. All of that is incrementally positive for the market. The market abhors change. Therefore, anything that creates a little bit more uncertainty and really a lack of action is going to be a positive. And it's also important, I think, to keep in mind that next year is shaping up a lot like the last major Republican pickup in a midterm election. If you look at the pickup today versus what happened back in the 1994 midterms, pretty similar. Obviously, the Republicans did not take control of the Senate this time around, but certainly a similar pickup, a similar sort of shift. 1995 was a great year for the stock market. It was one of the best years on record. Also similar in that cycle was the fact that we did see a softening in U.S. economic growth back then, and really a reacceleration in 1995. That also obviously helped the market. So I think there's a lot of similarities there, and I think that 2011 is actually shaping up to be quite a good year for the stock market. I don't think that's a consensus expectation right now. I think a lot of people are still thinking it's going to be kind of slow and sluggish just like it was this year. I actually think it's going to be a lot better than that. U.S. economy faces a great deal of longer-term problems, particularly related to a potential debt crisis later this decade. But I think 2011 is going to defy all expectations and be very, very positive. What sectors would I buy? Stick with the sectors I've been talking about for months and months now. Energy, strong economic growth overseas, and I think we have a good chance for a big run-up in oil prices into 2011 as well. Materials, things like chemicals companies, but also metals companies, etc. Same story as energy, really. Technology. Technology is some of the strongest growth, strongest earnings and revenue growth of any S&P 500 sector. Also strong exposure abroad, low debt, real pickup in spending there. So those would be three sectors I would look at. I see a positive market next year, possibly a quite strongly positive market in 2011. Buy energy, buy materials, buy information technology. Thank you very much.